Hello everybody, this is McCarthy, aka the Loan Guy, mortgage broker for Sceptre Mortgage. How you doing today? Today I'm excited. Last week I had the opportunity of speaking to a small group of individuals in a very intimate setting. We talked about, is this the right time to buy or purchase? What are the first steps in the mortgage process? We talked about down payment assistance and how do I qualify for it? We also discuss ADUs, accessory dwelling units, and what is SB 9. If you're a first-time home buyer or you're a seasoned investor, but you still have questions regarding mortgages, regarding processes, ADUs, it doesn't matter. Join me in this short but informative first-time home buyer symposium. TR, the Loan Guy, signing out. All right. First of all, thank you guys for showing up. And I really mean that. I love the more intimate settings like this.
Right.
Like I said, I've talked to hundreds of people, I've talked to thousands of people, but I like to be in where I can touch it. Exactly, one-on-one, right? And so before we get started, if you're coming in from YouTube, Instagram, or Facebook, wherever social media, we're not answering any questions, okay? But this video will be cut and put back online probably by the end of the week or Monday if time permits, okay? All right. I want to first say thank you to the entrepreneur guru, the business extraordinaire who invited me out here. She's also my past client, Miss Linnell. We're going to thank her for being here. I'm really appreciative of being here. She put this together for her clients to take part if they want to educate themselves on these things here, right? My next person I want to congratulate and thank you for being out here is Miss Rose.
All right.
B. Rose and Anita Jeter. Thank you very much. I mean, Rose, how long have you been in the business?
Oh, since 2009.
2009.
That's when I got my broker's license. I got my sales license in 2003. So that's 20 years. I can add that.
But see, she has a plethora of knowledge. She's been doing this. This is her life, her livelihood. That's priceless. So thank you for that. And the last person I'm going to thank for being here is my intern.
Yeah.
One of my two favorite interns,
Yeah.
Mr. Jaden, the numbers guru. Thank you, Jaden, for coming. Right now he's behind the camera, so he can't come over here, but thank you, Jaden, okay?
No problem.
All right. First time home buyer clinic, what you need to know, okay? We're going to talk about today. If you listen and apply the things I'm telling you today, the journey will be much easier for you to purchase your home. I can guarantee you that, okay? We're going to discuss, first of all, what not to do, okay? What not to do. We're going to discuss, is this the right time to buy? You have that question? First steps in the process, down payment assistance, then we're going to go to questions and answers, okay?
Mm-hmm.
All right. We're going to have a good time, okay? Also, all the people out there, I want to say happy birthday to my man here. I forgot his name again one time. Chris, that's right. Chris. Yes. Happy 48. Thank you very much. Thank you. All right. So, don't do this any of the time that you're looking to buy a home, right? These things right here. I always like this story because I call these people Negative Nancy or Bad Time Bobby. And we all know it. We all know. I know you know. I know you do.
Negative Nancy.
Bad Time Bobby.
Okay, I like that.
Because in every now and then, these people come in, they start talking. When I say every now and then, like every week, right? They'll say like, I shouldn't have to do that. I won't do that. I'm not providing that. I know you know that one. You don't need that.
Yeah.
And I should be able to do that. All-time favorite, right? Don't be those people. Anytime in the process, because when you reach out to a real estate agent like Rose or to a mortgage professional like myself, especially a mortgage broker, which I am, my job is to make sure that I have a fiduciary responsibility to make sure that I give you the truth, the right numbers, make sure that this deal goes right for you, and lead you to the right place you want to be. That's my whole job. And when you come in with that attitude, like, I'm not doing that, I shouldn't have to do that, or you talk to your auntie, your great auntie who bought a home in 1962, and she's been living in a house since then. She says, I didn't have to provide that. They don't need that. Back then we did. But can we all agree that life is not stagnant? It moves forward, right? Technology moves forward, and the mortgage rates move forward. Since 2001, they started something called the Patriot Act. 2008, we know what happened in 2008. Market crash. They started changing rules and regulations. We know what happened just recently in 2020. I can't even say it on YouTube. Fully taking my video down, right? But even just last year, even just in January of this year, the guidelines changed. It's a fluid animal and beast, right? So what we have is, just 2 weeks ago they made it, about 3 weeks ago they made a change to some guidelines, and now one of our lenders has down payment assistance, a proprietary one that didn't have it just literally 3 weeks ago. So everything changes. So when you come in and you say what happened 10 years ago, I'm gonna say you're absolutely right. But that's what's going on today. Okay? All right. When you start a process of buying a home, what you want to never, ever, ever do these things. Never buy a new car while you are getting a home loan. I say this and I joke about it, but she's seen this happen. I know you've seen it happen.
My friend did this last month.
Last month.
They were waiting for title to give them the money on the loan. The man went out and bought a car.
Before they fund it.
Yeah.
And that right there, that's terrible. You can't do it before you fund loan, because we pull credit once. However, right before we close, they recheck it. It's not pulling it to make sure that everything is what it was that we talked about. And when they see that car note, they say, hey, there's a car on here, and now you just put on anywhere between $500 to $1,000 in the car. Guess what happens to your debt to income ratio? You blow it up. What does it go? Right? So never buy a new car. Don't quit your job and or get fired. Don't do that. Don't get new credit cards and max them out. Don't go to Best Buy and somebody get this refrigerator for my new house I'm about to buy. Wait till you get the house. Okay?
Keys in hand.
You know what?
Keys in hands first.
There you go, sir. I appreciate it. Don't apply for another mortgage loan. You'd be surprised. People like, oh, I'm going to also apply for this loan and just see at the same time. That will blow your deal up. Can't have two loans in the same time process. Okay? What else? Do not stop paying your bills. I have people do that too. Like, oh, we're about to refinance on a home, and they say, I'm not going to pay that right now. Da-da. Why not? Until we finance that home, you still got to pay that mortgage, right? Right. So those are some things there. Again, don't be these people, please. Okay? Can you hand me that water bottle, son? I appreciate it. Gosh, all day today. We're going to talk about now, is it the right time to buy?
Yeah, that's
Everybody wants to know that. You want to know that, you want to know that, you want to know that, and you want to know that, don't you? All right, so I hear people all the time saying, I'm going to wait. I'm going to wait. I'm going to wait until the rates drop. I'm going to wait until the market cleans up. I'm going to wait until the cows come home. That's what they're going to say, right? I'm like, what are you waiting for? Now, again, the questions I ask people when they say that, I'm like, do you want to purchase a home? Because people tell me I want to purchase a home, but I'm like, actually, do you really want to purchase a home? Because if you did, your cousin, what you heard from your manager on the job, they're not going to talk you out of buying a home. Because they say like, hey, when I bought my home 10 years ago, when my cousin sold me his home, he was my real estate agent, he was my mortgage broker, he does a loan every 2 years, and he says that this is not a good time to buy. You can listen to that person. You can listen to a person who has over 2 decades in the industry, and I can tell you that that's not what it is. Okay? Why do you want to purchase a home? or you want to purchase a home because you're trying to keep up with the Joneses, because you think you want a home, like all my friends are buying a home, so I guess I should. You're not really trying to buy a home. You just, and this happens every week, right? People are like, I want to buy a home. Okay, I need this, 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 and this. Okay, I'm gonna get it for you. 3 weeks go by, a month go by, I'm leaving messages, and then I don't want to buy a home.
Yeah, no documents preparation.
Exactly. My thing is this: in any particular market, the rates, they go up, they go down, they go up, they go down. But it's across here. This is what it looks like. And I always say this: at any particular time, can you afford this home that you're looking at? Can you afford the payment? If it does not put you in harm's way, because I tell people that, does it put you in harm's way? Then don't buy that home. If it does not put you in harm's way, you're paying $2,500 for your rent right now. Most people are paying more than that. And your house is going to cost you $2,700 a month, or even $2,800 a month. Does that extra $100 put you in harm's way? If it doesn't, it's your home. You can say, well, the interest rate is 6.5% or 7%. This is not what you're going to qualify for. I'm just using these as examples. The interest rate is 6.5% or 7%, depending on what program you go with. And I say, what does it matter? What does it matter? Can you afford the home? Because right now, you're talking about a 6.5 interest rate, but right now with your rental that you're paying 25, sometimes 3, sometimes 4, I had a guy who was just paying $5,900 a month that we did a couple of months ago. And all I say is this: that's 100% interest, because you don't own nothing. You're not getting any type of equity. You're not building your mortgage piggy bank right here. Everything is out of your pocket. When you have to move one day, and you will have to move out of that apartment or that home you're renting, because when somebody passed away, the kids don't give a crap if you personally live in that house. Now they want to sell it, get the money out, right? But if you put it in your home that you can afford, you're not being put in harm's way, you're building equity every single month. It's like having a silent bank account. Can you pull them out? You can, but if you just keep letting it go, that goes down. Does that make sense?
Yes.
All right. I talk about the rates going up and down, but I would say this. Let's just say, for sake of argument, whatever the rate is, let's say the rate is here. Can't say it on this because they don't think they can get that rate. Let's say the rate is right here. However, let's say the rates in the next 6 to 7 months, it goes up. What happens then? That means you're good. You're still locked in at this rate because the rates went up. Well, on the flip side, what happens if the rates go down? If you're here and the rates go down, what happens?
Still like you can refi it, or it's a your mortgage, so write it out.
You're still good. So now, once you come down here, if you can afford this, all we do is a rate term refi. We don't pull any cash out, but whatever this rate is, if this rate's lower and it makes sense, I'm not talking about a couple of, like an eighth, I'm talking about a tenth, I'm talking about if it goes down a good significant half a point to where you're saving at least $100 or more,
makes sense.
That makes sense to do it, right? And so when you do that, all of a sudden now you are out there. So it doesn't matter if you're here. If it goes up, you're good. If it goes down, you're good. We just put you down there with it. Boom. If it goes back up, you're still even better. All right? Exactly. Again, if it does not put you in harm's way, it's always a good time to buy. So I'm going to kill that right now. If it does not put you in harm's way and you have it, you want to own your home, because I want to build my own mortgage piggy bank. Best way to build financial wealth is through a home. One of the fastest ways anyway, okay? Now we're going to move to, does anybody know how much it costs to buy a home in today's market here in Southern California?
At least $600,000.
Okay.
The average?
Average.
Yeah, at least.
All right.
$500 million home.
Exactly.
That's just bottom line right there.
Before we say the house, I want to ask this question. Do you know how much it costs to buy the average cell phone now? When I walk into the latest Verizon, AT&T, Sprint, want to buy that latest and greatest phone. that Galaxy S24 Ultra, that new iPhone 15 Pro Max with the screen that goes like, oh my goodness, look how bright that screen is. I know 15 years ago, it would have set you back roughly about $200, $199. You put down $199, you get any phone you want, right? Here you go. Not no more. That new phone gonna cost you how much? About $1,500. You walk into the store, you're gonna put down about $300, and you're gonna finance the rest for about 24 to 36 months. Is that about right? Am I lying? Okay. And I'm a phone guy. I'm a tech guy. I used to, man, I'm a tech guy. I love stuff, so I know these numbers here.
He's all right.
Exactly. Okay, so what happens if you want to buy a home? I'm gonna take those same numbers and I'm just gonna multiply them by 300. 300% increase. So let's talk about it, right? $1,500 for the phone times 300. Let's just say 450. These numbers are a little bit low. $450,000. Right, buy something in it.
Yeah.
Dining area, things like that. Still right there, right? So let's say that $300 deposit we talked about is about 20%. Multiply that by 300, that's $90,000. For a conventional mortgage, especially back in the day, that used to be the average. You're putting down 20%. So at $450,000, you'd be putting down $90,000. People are like, oh Lord, I don't want to do that.
Yeah.
Right? I can't do that, right? However, now instead of putting down 20% for a conventional loan, you can put down 5%. 5% is roughly $22,500. Or 3% if you're a first-time home buyer on a conventional. Okay.
Conventional.
Even on a conventional, first-time home buyer can do 3%. Yes. Plus closing costs. Okay. Plus closing costs. If you're doing FHA loans, it's 3.5% down. Plus closing costs. 3.5 would be $15,700, which is a far cry from that $90,000 we talked about, right?
Right.
You can do this too. All right. Now, what's the first step? Anybody know the first step to get into the home?
Talk to her about it.
And a home.
Lender, realtor. Look, check your
You
finances
want
out.
to get qualified for it.
Yeah.
Yes, you want to know your purchasing power. That's how I brand it. You want to know your purchasing power. What you qualify for? Yeah. What's your purchasing power? Okay. Purchasing power is really simple. What is your budget? How much do you have saved? I get people saying, you know what? I make really good money. I have nothing saved. Nothing saved. Now,
That's true.
have we worked with worse than that?
Oh, yeah.
There are programs called down payment assistance that will help, and we can also help with seller credit sometimes and things like that. But we've done worse. What's your credit score? Some people say, you know, my credit score is terrible. And then we pull credit like, you got a 780.
Yeah.
Oh, what are you talking about? My credit score back? Oh, it went up. Or some people say my credit score is good. I'm good, man. And I look down like, dude, your credit score is 480. That's the difference between my credit score is good and 480, right? You got some things to talk about.
Yeah, this is one thing too, you know, all of the little credit companies, they don't have the same weight as when the mortgage company pulls your credit. And sometimes your credit is better than and sometimes it's not. But
Well, that's a good thing. So what Ms. Rose just said is sometimes when you pull credit on these other places, like if you go get a credit card or even a car, it's a different FICO score, it's a different system than when we pull credit for a mortgage. It's a totally different weighted system, okay? So sometimes they're very similar, sometimes they're right on, sometimes they're completely different. That's very true. I wish I knew why.
That's right.
All right. What you want to do is improve or maintain your credit. Real simple. Obtain a free copy of your credit report annually. Pay off any delinquent credits if needed. So let's just say you come to me and we pull credit. We make a game plan on how to get you into your home. Let's say you have some collections on there. People say, I'm gonna pay those off first. I'm gonna do this. You may not have to do that because the guidelines state in different situations that if you have over $1,500 of collections for FHA, you do have to pay them. You have to pay them off. You got to pay them off at closing. But what if you go to conventional and we go with we call it automatic underwriting system? That system may say you don't need to pay those off, So if you don't need to pay those collections off to get into that property, why would you do it?
Basically,
Exactly.
that's part of your deposit.
Exactly. You can use that towards your deposit or your closing cost. Okay? Pay your bills on time and keep credit card balances relatively low. All right? If you want to receive a free copy of your credit report, you can go to annualcreditreport.com. Start saving now. It's not too late. Okay? Save for your down payment. The amount, again, depends on the mortgage type. Again, if you are a conventional, you can go 5% or 3%. If we go FHA, that's 3.5% plus closing costs. Okay? What are closing costs? Closing costs includes property taxes, homeowner's insurance, the appraisal, title and escrow, and other fees, because there's a lot of different things in there as well. They typically range 2 to 3% of the home value, to say. All right. Do anyone know what a mortgage broker is as opposed to a loan officer who works in a bank?
Mortgage broker have more option.
You remember my spill about the phone. She's talking on the phone.
No, it's
a
mall. Like, put it in a mall. More than just going into a mom and pop. Yeah.
Right. I started out, I worked for multiple banks. I worked for Wells Fargo, Bank of America, and I worked for multiple lenders throughout the years. Bank also, Lehman Brothers Small Business Finance before they went defunct. I started out at Lehman Brothers on their small business side. I was actually a processor. From there, I worked my way up as an underwriter, became an underwriting manager, branch manager, and those things until I started my own company. As a broker, I don't need this. As a broker, I have access to multiple lenders. And I have the ability, let's just say for sake of argument, you come in with a very unique circumstance and I don't have that particular program. All I gotta do is pick up the phone and find out the lender that has it, and I can associate with that lender and get that program for you to make sure you have it. Okay? I have a fiduciary responsibility, as we spoke about earlier, to give you the truth. I can't make money on the back end of your loans. Back in the day, let's just say you qualify for a particular rate. Let's say it was 5%. But back in the day, the LO, the loan officer, got you to get a 5.125 or 5.375. That extra point is called yield spread premium. They used to go in the pocket of the loan officer or the bank. Okay? The banks actually still do that, because after 2008, they say, oh, mortgage brokers or LOs, they're a cancer on society. We got to make sure they don't get any pay. Now, the banks make the programs, and they can still charge you yield spread premium, but they don't have to give that to you. So now, let's just say you will qualify for whatever percentage you qualify for, but let's just say you need a little bit of extra cash for your down payment. So instead of, as an example only, you get a 5% rate. But we can give you a 5.12 or a 5.275 and give you back, let's just say, in theory only, an extra $2,000 or $3,000. That money now, instead of going into my pocket, it has to go back to you and use that for your down payment or closing costs. Does that make sense?
Makes sense.
If you go to a bank and they get that percent, they don't give that to you. That goes like this. Thank you very much. I appreciate it. Okay. Now, a LO in a bank. A retail bank handles the loan in-house. When you come to me, I pull credit once and I can shop this around to all my different lenders. Multiple states, we can do that and find out the exact program for you. Okay? Let's just say you're self-employed. And when you are self-employed, you like myself, I'm self-employed. And on most self-employed entrepreneurs, taxes, you write off everything. You write off your goldfish, your dog, its food, and all your utilities and everything else. And it limits what you actually make on paper. So if you want to buy a home, if we make a ton of money and we can prove it on your tax returns, we can use that. What if you don't? We have something called a bank statement loan. A bank statement loan. So I can utilize your bank statements, 12 months, 24 months, doesn't matter. Let's say 12 months. whatever you have going in there, if I can cut that in half and use 50% of your deposits and you qualify for the house, boom, we're good.
Oh, okay.
What if we need a little bit more? All I need is a letter from your CPA, whoever does your taxes, saying, hey, his expense ratios are not 50%, but it's only 20%. So now I can use 80% of your income or your deposits as your income. And now you will qualify for the home. Most banks do not have a bank statement program. Am I right?
That's right.
That's
But
what
brokers do.
brokers. Okay.
Most banks are not doing what we call FHA HECA mortgages, or they commonly known as reverse mortgages. When I say that, people are like, oh my God, you're going to take my mama's house. No, we do reverse mortgages, and it's a great program because that reverse mortgage, they won't tell you this, but it's just an FHA loan that has different criteria. You can pay it back like a regular loan. You can pay your principal and interest. They don't tell you that when they talk about that. They can say, oh, the interest is going to go in the back end and they're going to take my mama's house. You can pay the interest if you want to. Or you don't pay anything, just the property taxes and the insurance. For people on extremely fixed incomes. If you're on extremely fixed income and you can't pay your mortgage anyway, if I give you a mortgage that you can stay in your house, no one kick you out until you absolutely pass away. Your kids still have the ability to take over that home when you pass away, but they have 12 months in order to do it. On a regular loan, you only have 3 months to either sell that house or refinance the house or lose it. Okay? So you see the difference? We have multiple programs to help anybody who needs help if they so choose to listen. And like I said, the banks only offer the bank's product. I know Wells Fargo is not even offering certain things now. They stop. They say, hey, they're A-paper lenders right now. You want a regular conventional, FHA, maybe a VA. Anything else, you're good. Exactly, right? So before you shop to buy a house, the very first step is get pre-approved. I don't care what you do, the very first step in this process is you have to see, again, what you qualify for. We calculate your income when you come to us. So you'll either give us your last 2 paycheck stubs and the information we need. We're going to calculate your income. I'm going to pull your credit to get your FICO score and your liabilities. With that, we're going to calculate your debt to income ratio, or DTI. I know people heard that word, DTI, debt to income ratio. Okay? And then we issue a pre-approval, not a pre-qualification. Now that I think you're going to qualify for this, I know exactly what your qualification is, and we give that to you, and then you take that and you hand it to your real estate agent, like Miss B. Rosanita Jeter, by the way, everybody. And she says, I got this approval, I can start looking for a house for you.
That's right.
Pre-qualification is really simple. I think that you're going to qualify for something. But I can say you qualify for $250,000. When you go to do your shopping, you come back and say, I got this pre-qualification, I want to get this house. Then you come back and you give all your documentation and you don't qualify for that. You qualify for $150,000. You don't want to be in that situation. That's why you get pre-approved. You know the difference now? So if somebody say pre-qualification, you say, you drop kick them in their neck and say, I don't want that, okay? I want to go ahead and get pre-approved.
How long does the pre-approval last for?
3 months, 90 days. But inside that, we still got to update your documentation, okay? So let's just say you get pre-approved, you lose a job, stuff like that, all right?
Don't go buy a new car.
Don't go buy a new car yet. What are the documents required to get your pre-approval? You need 30 days of pay stubs if you work a W-2 job. You need W-2 forms, your last 2 years. So that'll be, for now, it'll be 2023 and 2022. If you are self-employed or you get commission or anything like that, you can also be required to have 2 years tax returns or business tax returns, okay? 2 month bank statements to prove your cash to close. All pages. Every time I tell people this, it never fails. If you miss out the blank page, what's this, a blank page, but it has a page number on it, right? Your statement says from 1 through 8, and I'm missing 7. Can't do that. You also can't. This is your bank account number. And you go. You can't do that neither, because we need to see your bank account. Why you need that? I don't need it. It's the guidelines. We gotta verify everything. Then the last thing is, again, if you are business tax returns, or if we're gonna go bank statement, we can go bank statement loan, or we can go, let's say you're self-employed, but you get 1099s. I got 1099 loans. Didn't know that, did you? I can look at your 1099s and make this so easy.
Okay.
All right. You're a migrant worker. If you have an I-10, I can do I-10 loans too. But you gotta have an I-10 loan, and you gotta have your work permit. All right. Once we do that, then you go shopping. Again, one of the best in the business right now, right behind you guys, Miss Rose can do it. She makes it happen. You're gonna find that real estate agent through a personal recommendation, or a recommendation from us. If you come to us, I got tons of people who are real estate agents, and I like to pick people who fit in personality wise. But I can just give you also just numbers to call. You can see who fits for yourself as well. You can interview them and say, why should I pick you? And they can tell you what it is. And then you're going to sign what's called, is it a real estate contract?
Residential purchase? Oh.
No, not the purchase agreement, but the
buyer-broker.
Buyer-broker agreement, yes. Right. Then you're gonna basically sign a buyer-broker agreement, which allows your real estate agent to represent you in the process and make sure you don't get fleeced. I know plenty of people have been fleeced. I said, I don't want to go. I'm going to go and do this myself. I'm just going to do the seller forms. Fleeced. I recommend getting a professional. All right. And then the last thing is this. Who pays your buyer's agent's fees? Currently, right now, the seller's been paying the buyer's agent's fees. Okay, that means their commission. However, laws have changed. And the laws are stating now that the seller doesn't have to pay your buyer's commission. So that means either A, you will pay that buyer's agent's commission and then the loan process, or you can set up, as long as you're negotiating a buyer's contract, buyer's agent agreement to get seller's credit. And that seller's credit will then pay your agent's commission. Okay? Any questions on that?
Seller's credit, the money comes from where?
The seller.
From
the seller. The seller would give you, and they do this all the time. So that's easy. Making an offer. Your real estate agent will guide you through the process of making an offer for the home that you say, that's the one I want to live in. Your agent will negotiate on your behalf. Do not try to call the seller saying, hey, you know I'm a veteran, or hey, I got 25 kids from 2 different women, and I need this house so I can bring them all under one roof. Don't do that. They're not going to talk. Well, they may talk to you, but it's not going to work. The types of offer you can actually go. It's a full price offer. So say the house is worth $500,000. You're going to put in for $500,000. You can make below asking price offer. You know, it needs a little bit of work. And the comps that my professional real estate agent says is most of the houses in that area are going for $450. So I want to bring that down, right? So no shit. Or you can do over asking price. People always say, why would I ever pay over the asking price? And I'm gonna tell you like this, because you want the home. Okay?
Because you want the home.
Because you want the home. That's it. Because a lot of times you can get that house, and if you don't move fast enough, a lot of people want that same house, and they're gonna try to lowball them, or they're gonna try to give them just what they asked for. Got 3 offers. Says, hey, I'm gonna pay $5,000 over, maybe 10, just depending, right? She'll know that, and she'll say, I recommend this. And every time she's done that for the clients we work with, she was right. Then they may give you a counter offer. The seller may say, hey, I like your file, but this is what I want to take. You may offer $485. They said, we'll do it for $490. That's a counter offer. And you say, yes, offer accepted. Once it's accepted, you bring me that purchase contract. I put it in my little computer here and I start doing this. And usually it takes about 30 to 45 days on average to get your home done. But how long have we been doing Ms. Rose?
He got Lanita's done 2 weeks after she
2 weeks?
gave him all the paperwork.
We average about 2 weeks.
Oh, that's beautiful.
If you're serious, you're motivated, you give me all the documents I asked for, because I'm not going to ask for anything I don't need. Remember, my brain thinks differently than most other loan officers you ever dealt with, because I'm an underwriter by profession. I think guidelines. You say, hey, you start talking, my brain is like over here. You're like, is he listening? Yes, I'm listening. I'm thinking about the guidelines. You say, okay, this is going to work. And then you say one last thing. Oh, I have back taxes. Scratch it. That's not going to work. This is going to work over here. You got back taxes. We got to go this route. And that's how my brain thinks. Okay? Once you get that offer accepted, you're going to do something called earnest money deposit. You want to know what that is?
But that's for
That's your deposit for the home. That's your deposit to hold the home. It's usually 1%. 1%. Normally it could be more depending on the she areas and things like that, but about 1% of the sales price. That earnest money deposit, or EMD, what they call it, can affect what happens to the deal. So let's just say you go through this whole process, you put your earnest money deposit down, you go all the way to the last day, and you about to close on this deal in 2 days, and you say, you know what? I was just kidding. I don't want to do that. Well, that earnest money deposit, because if you have removed all of your contingencies and you say, okay, it's worth it for the appraisal, okay, I did want the house, and you remove those things, you can lose your earnest money deposit.
Right.
But you got all those things that have to happen though. Okay? And once we close, whatever you paid up front will be subtracted from what you bring in at closing. Okay? So let's talk about the types of loan programs. Everybody wants to know that. You have conventional. What's conventional? That's just a standard Fannie Mae, Freddie Mac loans. Everyone said, I heard of Freddie Mac and Fannie Mae. They're the two agencies that govern the loans. They make different rules and guidelines that we have to follow to meet these certain criteria. That's the one that before it was 20% to put down. Now you can do 5 or 3%. If you're first time home buyer, 3%, but you will have to pay mortgage insurance. If you put down at 20%, you don't have to pay mortgage insurance. Okay. The next one is going to be FHA or HUD. FHA is a government program. Has a little more guidelines to kind of hoops to jump through, but it's very good because it also gives you more flexibility. Okay. However, with a FHA loan, you got to pay mortgage insurance or MI the entire time of that you have the FHA loan. So on a conventional at 80%, right at under 80%, it drops off. With the FHA, it never drops off unless you then transform it to a conventional loan. Okay.
Question.
Yes, ma'am.
FHA, is there a limited amount of money you could borrow?
Absolutely. Every county has its own limits, and they just changed it again. I think we're up to 700 and something now for the Inland Empire. I don't have the exact amount on me, but I'll put it on the video and have that amount. But it's like 7. I forgot the exact number, but I have it on my wall at home in my office. Then you have a VA loan, government loan. I was just at March Air Force Base. When was that? Just this week or last week?
It was this week. Tuesday, I believe.
Tuesday of last week, okay. I was just Tuesday last week. And I'm going to be there again next week. I'm doing classes up at the VA to teach home ownership 101. Okay? And that's pretty much if you are a veteran, the VA, if you're a veteran, you have something called Veterans Benefits, and you can get a VA loan that will allow you, in some instances, to put 0 down, pay your closing costs, and you have a lot more flexibility. You got to meet the criteria for that loan. Okay. Then you have what's called non-QM or non-qualified mortgages. Qualified mortgages is that conventional, and FHA falls in that traditional arena. The things that don't qualify now, like it's a bank statement loan, it's called a non-qualified mortgage, or a 1099 loan, or you want to get an investment property, a DSCR loan, to where we lend on the value of the home and not off of how much you make. Okay, so we have different types of loans. What are the types of interest rates? You have a fixed interest rate, and you have a adjustable rate mortgage, or ARM. The fixed is just what it sounds like. If you get that rate, it stays this rate for the entire length of your loan. Okay? Adjustable rate mortgage is just that. It adjusts depending on where the market is. Okay? There's usually a cap. You can't go higher than this. And so let's just say you start with this amount right here, and then it can only jump so many points or so many tiers throughout the life of the loan. So you can go here, 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 caps right here. But what happens if the rates go down from even right here? Guess what? Your rate goes down too. So wherever that rate is just where it is. And so why would somebody get an adjustable rate mortgage? Sometimes when you first get that adjustable rate mortgage, it's lower than a fixed rate in days past. It's kind of lower. So let's just say you know that you may either buy a home and move within 3 to 5 years, because sometimes you have that first adjustment can be 3 years, or it can be a 5 year, and then it adjusts. So you get that lower rate for 5 years, and in 5 years, you know, I want to sell this home to buy my next big home because this is my temporary home, but it's not my forever home. You'll do that. So within that first 5 years, you know you're going to sell a house. Boom. And if you don't sell a house, then you just go ahead and rate term refinance for whatever that rate is at the time. If it's lower than what it's going to go up to, that's all you do. Okay. Underwriting. I'm an underwriter. The underwriter will review your income. How much do you make? Gonna review the property, what you're trying to buy. He's gonna look at your assets, your bank statements, see how much money you have in your bank accounts in order to pay for the down payment and closing costs. That's all we carry. And sometimes if you have reserves is depending on the program you're gonna have. Let's say you need a reserve of 3 months. What 3 months reserves means is you need 3 months to pay your mortgage and anything related to your mortgage for those 3 months in your bank. And then you look at your credit and make sure you have paid back the loans you have borrowed before. Okay. Next, we're going to talk about the appraisal. The appraisal is a very important part of this. No one's going to lend you any money if you don't get the house appraised. Now, sometimes you do not need an appraisal, but usually you put it down a lot of money. So that means that you're going to at least 20 to 30%. And after that, we say we don't need an appraisal because we know historically by the data we have in Fannie Mae and Freddie Mac how much that tract is worth. Okay, so if it's below the average tract, you're good to go. All right. The process determines the value of the property. Is based on the detail of the home and current market value. It can take up to 2 weeks to produce, I should say. So for a guy to go out there, it depends on how much time you have. The lender determines if the purchase price is supported. What if your purchase price is higher than the appraised value? So what if your purchase price is $500, but your appraisal comes in at $480? Do you know what happens then?
They said to go back to the seller. They said they're going to sell it to you for that price.
Exactly. Well, really, no. Unless they put it in the purchase contract that, hey, if the appraisal comes back lower, you're going to be willing to pay the extra $20,000 for the house. Or if not, if that's not in your contract, then usually the sale price drops down to whatever that appraised value is. Okay? Now, am I wrong? The seller has an option if they want to sell at that price. They don't have to, right?
They don't have to.
Exactly. But I haven't seen that happen unless it was something really crazy.
Seen that happen.
Yeah. All right. Am I answering all the stuff you want me to answer?
Yeah.
Okay. Once you get the appraisal, once we sign off on all of the conditions that we give you, we get something called a clear to close. Clear to close is just that. We sign off on all your conditions, the appraisal matches, you guys have the money to pay for it, you guys have the money to do your down payment and closing costs. Clear to close typically takes about 30 to 45 days, but again, we've been getting them in 15 days. Closing agent, which is your escrow officer, will prepare your closing documents, which is going to be your actual loan docs. Okay. Okay. When we close, though, it affects your final cost. So let's just say we get it done early, but we're going to close on the 3rd of the month. That means from the 3rd to, let's just say, the 30th of the month is 27 days. And now you got to pay 27 days of per diem interest or per day interest because they got to pay that rate, right? Because we're going to close in there. What happens if we close close to the end of the month? It's only 5 days. We're only paying 5 days of interest. So the amount out of pocket goes down a little bit. This depends on when we close that deal, okay? And during this time, you're going to work really closely with your loan originator. The closing day. This is when everybody gets extremely happy and extremely nervous. Every time I hear somebody say the closing day, they look like, oh. They freak out, right? So what to expect? I'm going to tell you what to expect so you don't freak out. All right. We're going to send out a notary to you. Notary's going to come with all the documents. It's going to be a stack about that big. Okay?
When you guys get into this, be aware that there's going to be close to 100 documents that you're going to have to sign. Then we would have been forewarned.
Really? It can take up to 1 to 2 hours depending on how your notary works. I haven't seen it take more than an hour, but it can.
Right.
Expect to sign multiple pages. When you get done, if your hand's not looking like this, you did it wrong. Okay? You're going to have to print. But you're going to pay it. Now, again, now you can actually do a lot of the signing online. You can actually sit on a package before the notary comes. You can e-sign a lot of the documents, but you can't. In California, you can't e-sign the whole thing. The notary still has to come out. You got to fill out the note and stuff like that. So that's pretty cool. The notary will not be able to answer any questions pertaining to your loan. Why, Mark? They cannot answer any questions pertaining to the loan. Okay? All right. The notary will verify your driver's license and your signature to make sure you are who you are, so no one is misrepresenting you and putting that on your credit report. You're going to make sure that happens. Okay? What you need to bring: your government, not your government, but your government ID. And a smile, because you're going to need it. Okay? All right. Before I go to the next session, do you have any questions?
So far, clear.
All right. Now we're going to talk about the thing that everybody wants to talk about. You know what that is?
What?
Down payment assistance.
Oh yeah, down payment assistance.
Down payment assistance. Everybody wants to know what is down payment assistance or DPA. DPA is probably my most asked question every single day, twice a day. Every time I go any place, they're asking about down payment assistance. What is down payment assistance? And how does it work? And do I qualify? So let's say this. Down payment assistance is real simple. There are multiple programs for down payment assistance. We have regular down payment assistance. We have grants. The difference between a regular down payment assistance is they give you anywhere between, if it's a conventional, 3%. Some programs give up to 5% for down payment assistance with down payment and closing costs, okay? It is a silent second that sits on the back of your loan. So whatever your first mortgage is, we give you 3%, that 3% sits on the back of your loan. Most programs, we deal with Cal HFA or Cal HAFA, Chinoa Fund. We deal with GSFA, not too much, but we still do a lot more. And we have proprietary down payment assistance program from our different lenders who have approvals with FHA and sometimes Fannie Mae. So we have multiple down payment assistance. It sits on the back. You don't have to make a payment on most down payment assistance, but on Cal HFA, it does accrue 1% annually on that amount. So let's say you get $15,000 down payment assistance. Every year, it will accrue 1% annually on the back end of that loan. We just got a new one where you can get up to $15,000 of down payment assistance. So that'd be the max. So anything under that, you get 3%. Once you hit $500,000, that's 15%. And it doesn't matter after that's 3%, $15,000. But that one doesn't have a payment and it doesn't accrue any interest. Really? That's pretty cool, right?
No payment and no interest?
No payment, no interest. Sits on the back end of the loan. That goes to my number one lender, which is UWM. And they've been, I was out there, 2 years ago? And I was talking to the owner. I was like, I need down payment assistance. I'm not saying that he did it for me, but I remember I was there and I was talking to him. I need down payment assistance. I told him about the Cal HFA. And he was like, yeah, but that's kind of hard to do. So, but he got one done through Fannie Mae. That's proprietary to them. 3%, no interest, no payment, sits on the back end until it goes. We still recording?
So that's back in is after 30 years?
So we're gonna talk about that right now. We're gonna talk about that right now. So 3.5, I want ahead of myself. All right. Before we do that, let's just talk about this. So let's just say if you have a loan amount of $300,000 at 3.5%, that'll be $10,500 that goes on the back end. Okay. This is now your second mortgage. So you have a first mortgage, you have a second mortgage. For a Cal HFA, like I just said, there's no monthly payments, but you do accrue that 1%. On this other one we just talked about, there's no 1%, anything like that. So when is it due? When you either refinance your first mortgage, when you pay off your first mortgage, when you sell your home. If none of these things happen that I just talked about, then it just sits there as a silent second until you get your 30 years. And then that's when you tackle that. Okay?
All right.
Can you get multiple assistants?
The answer to that is yes and no. For the most part, yes. So let's just say, for instance, but let's say the Cal HFA. There's two types of down payment assistance you can get. The My Home, which is at first either 3 or 3.5%. And then they have something called the Zip loan. That's a third loan, which is for closing costs, and with that, it can be an extra 2%. However, on FHA right now, they don't have that Zip loan because the rates are a little bit higher than they traditionally have been. And so let's just say they don't, because the more money you get, the higher your rates are going to be. That's just the way it is.
Right.
So let's just say we just did one, and it's funny because we just did one that was actually about 6, at the time that we did that, it was about 6.875. They got 3%. If I was going to get the actual extra 2%, it would have been, I think it was 7.5 or somewhere around there for that first mortgage rate, right? Now, some people can afford that. They say, I'm good. I'm just paying my down payment and most of my closing costs. So, but traditionally, I don't add the Zip on. I just do the 3 or 3.5%. Because what happens with the 3 to 3.5%, what we've been finding out is once we get that, now you come out of pocket, depending on the house, anywhere between, they only came out of pocket $6,000. One person came out of pocket like $9,000. Some people come out of pocket about $15,000. But that's a far cry from coming out of pocket $30,000. You see what I'm saying? So instead of coming out of pocket $30,000, say you come out of pocket $15,000 and you can buy a $500,000 home. Is that good for you?
Better than coming up with 30.
Exactly. And so that's why. So if you can afford it, you don't have to have that extra 2%. That's what it is. Now, to answer your other question is, there are multiple down payment assistance from communities, counties, cities, and things of that nature. But in my experience, when I first started this business, I would call different counties and cities, and I have a whole list of people who have down payment assistance. Hey, got a client looking to get that they're gonna buy in your city. Can we get that? Oh, we don't have any money. I'm like, it's April. It's April. Oh, we haven't had that money for the next 2 years, but they said they're gonna send it this year. I kid you not. So I stop even looking. I go traditionally, Cal HFA, Genoa, or my non-proprietary down payment assistance with our lenders, because some of us have their own down payment assistance through FHA and through Fannie Mae or Freddie Mac. Okay, but technically yes. So let's just say that city had the funds. Absolutely, you can use that if they have the money. Okay. Any questions on down payment assistance?
How do you qualify?
How do you qualify? Good question. Down payment assistance is really simple. There are different parameters, but basically based off your FICO score. So let's talk about Cal HFA. If you're doing a conventional, here's my kitchen here. If you're doing a conventional, I believe it is 680. You have to have a 680 FICO score. Okay. You have a 680 FICO score, your DTI is good, you can get that. On an FHA portion, it's 660. You have good FICO score, DTI is there for 660, you qualify for that. On a Chenoa fund, it's only FHA, as long as you have over 600 FICO score. 600 FICO score, you can get that. Okay? So there are different parameters for different DPA programs. But that's the first thing. But when we do, let's say we send it through Cal HFA, at the end of our loan, we have to send it over to Cal HFA, and they got to do their last review. I haven't had one come back denied at all, but they had their last review, and then say yes, we approve it, go for it, blah blah blah. Okay, so FICO, first time home buyer. You gotta be first time home buyer for most of those DPA programs. And there's multiple programs. You have one that everyone talks about, which is the California Dream for All, right? Have you heard, last year we had that program. Within 9 days, they ran out of money. 9 days they ran out of money. It was crazy. They brought it back this year. However, it's a lottery. It's not first come, first serve like it was last time. They literally, Ms. G, you got this. Right. Or Chris, you're up. Yeah. But the criteria for that one is a little more strict. You have to be a first-time home buyer generationally, which means your father, your mother, your stepmother, your stepfather, your foster mother, your foster father, or the person you just lived with cannot have owned a home prior to you. Okay? So there are different guidelines, there are different things. But traditionally, just a regular down payment, it's just based on the FICO.
Another question, what's considered a first-time home buyer? I know it's in the name, but I also heard you don't have to technically be a first-time home buyer.
Great question. What is a first-time home buyer? The definition of a first-time home buyer. It's real simple. You haven't owned a home in the last 3 years. Okay? So that means you could have had a home 5-10 years ago and you sold it. 3 years after that, you're now considered a first-time home buyer again. All right? Again, they're trying to change it for these other programs, first-time home buyer, but it's like generationally. So that's it.
And so basically, if you have a home, 3 years later, you still have a home. Mm-hmm. Are you still considered?
Absolutely not.
What about if your home that you bought 3 years ago is now in a trust?
You're trying to do semantics on it, right?
You could get back to me.
No. I'm actually going through the guidelines in my head right now. Hold on. Hold on.
He's computing.
I am computing. That's a great one. I've never even asked that question. That's a good question. Because technically you don't own the home anymore. On actual
paper
title.
Yeah.
The trust owns the home. I would then consider you to be a first-time home buyer in that situation. But I'm going to actually check with the guideline agencies. I will get back to you on that. But from my underwriting brain, technically, you after 3 years of it being in a trust, you're now a first-time home buyer. Because the reason why I'm saying that, because technically on your taxes, you can actually rent the home from the trust, which means you no longer own a home. So yeah, that's what I would say. Yeah. Okay. If I was underwriting, I would say yeah. But I'm gonna check and I'll get back with you. Right now, it's question and answer time. I tried to condense everything, and there's so many other things I can talk about now. Different programs. We talked about the bank statement program. We talked about 1099 programs. Let's just say you want to purchase a home for investment. All right. You can, of course, do the conventional route. Let's just say you want to buy a 2 to 4 unit property. It's going to be for an investment. but you're gonna live in one of the units. That's the beautiful thing, right? So it's your primary and it's an investment property. So if we're gonna go with conventional, before you had to put about 10% down. Or now, what was it, 15? Yeah, 10%. Now though, if you live in one of the units and you're out the other ones, you can put 5% down. Okay. On an FHA loan, you have to live in one of the units. You have to, because you have to. So if you live in one of the units and you do it, you can still do 3.5% down because it's FHA. So different programs, but let's just say you don't want to utilize your income or so to qualify. That's when you come down. We go back to the non-QM loan. We go back to the non-qualified mortgage loans. We're going to look at this property, and let's say you put down 20%. You got to put down a little bit more though. Between 15, 20. If you have, let's just say, not so nice credit, can't say bad credit anymore. It's not robbing anybody.
Just consider not so nice credits. Or the 660.
I would say good credit is between 660 is 640, 660, really 660. They say that's good credit, right? It's getting to good credit. When I say not so good credit, I would say, let's say closer to 600. But I've also seen into 500. Now, to do what we talked about doing with what's called a DSCR program, you're gonna probably need to be closer to 660 or over. So let's say you're 660 and over. If you're at 660, you're probably putting down about 20%. But if you put down 20%, I'm not looking at your income. I'm looking at the cost of that property. I'm looking at how much you have equity in there. I'm also looking at the actual rents of that. We're taking that into consideration.
The income off of that property.
Absolutely. So I'm not looking at your income. I'm looking at the income off the property, and I'm looking at how much value we have in that property, how much equity we have in it. And if everything computes, which 9 times 10 it will, we can get that without having to go into your tax returns, without having to go into your income. It's based off the property. That's how a lot of people get units, just through that type of loan.
Question.
Yes, ma'am.
Would those 1 to 4 units be qualified for down payment assistance?
When we talk about investment property, there's no down payment assistance for investment properties.
But you're gonna live in one.
You know, that's what I'm saying.
Only if you're gonna live in one, you can do it, but it would have to be limited to a 2 unit.
Okay.
You can't go
Like
4
a
units.
duplex.
Like a duplex, yeah.
Okay.
It wouldn't be a 3 or 4 unit. And that's a particular program. In that program, you gotta jump through some other stuff, but yes, you can. Okay? All right. These are great questions. Keep them coming. I can be here all day. So we talked about investment properties. We can talk about, let's say you want to build something. You know, I want to build a home, or I want to buy a home, and what was it? This week I was just at I was in Reseda, North Hollywood, and that was Thursday, I think it was. Thursday. Thank you for knowing my calendar. And got invited to come out and look at a few ADU manufacturers. They're doing steel frame construction, building ADUs, additional dwelling units. Pretty sure you heard of those.
In the backyard.
In your backyard. They just, man, if you understand, when I talk about building wealth for yourself, this is one of the quickest ways to do it, because now I went to view 2 properties. Home up front, old home. It's an old home. The ADU was an 850 square foot ADU in the back. It looked amazing. It looked better than the main property. And in Reseda, they about to rent this thing out for over $3,000 in a backyard. The beautiful thing, because they just changed the laws here in California, you can have an ADU and you can then have a junior ADU. If your lot's big enough, they have this new program called SB9, Senate Bill 9. Excuse me. Senate Bill 9 means you can build an ADU. It's technically ADU, but it's now Senate Bill ADU, which means he's going to have his own address, his own utilities, and everything else. Once you do that, you now change your single family into a multi-unit property. If you just do the ADU, it's still just a single family property. That's just like an extra room. But if you do the SB9, same laws, same rules, everything else, just costs you just a little bit more to get it address and all that stuff. But I would recommend doing that because now, if your lot's big enough with the SB9 unit, you can now make that's going to be considered the second main unit, and you can now have an ADU off of that, and you can have another ADU off the main home. That's what the contractor was showing me when I was out there, and he says he put the ADU, this is the main house, he put the ADU all the way in the back. What he's going to do, that's the SB9 unit. He had a detached garage right there. He's about to change that garage into an ADU for that SBU9 unit.
And then he's going to build a new.
And in this area right here, he's going to build about a 500 square foot ADU right from the main house. So you're going to have 4 units. He's living in one, and you're going to have 3 units that he's renting out. He's doing it in phases. I kid you not. This is something that if you hear what I'm saying, you have vision. I'm telling you, this is the future because entrepreneurs are doing this. They're having homes, and all the homes they own, they're putting ADUs on them. Not just one, but multiple. And when they're renting them out, each one has their own little small section of yard. This wasn't even a huge lot. It was a nice sized lot, but you can do this legally now with the California laws. ADUs, I'm telling you, it is the way. Yes, ma'am.
That program, the grant,
$40,000 grant program
to do the foundation.
It's for the soft cost, and that comes in and goes out too. But what she's talking about, there's a Cal HFA grant that will give you up to $40,000 to help with the cost of building your ADU. So let's say you apply, you get that grant. You gotta then get qualified to get the money to build the ADU. Once you build that ADU, that money goes for your soft costs, like your like you said, foundation, stuff like that, your plans, all of your permits and things like that, up to $40,000. It goes in. Whatever's left over goes to pay down your mortgage on that place. Okay? And so it's a great program.
Pay off the mortgage on your original
on the loan that you got on that to build that new. It goes to pay that loan down on the principal of it. Okay. Great business. Great program. But ADUs, if you are looking to purchase them, that's why I say get a house.
Land space.
Huh?
Land space.
Exactly. And it doesn't have to be huge. It doesn't have to be huge, but it has to just fit certain criteria. I have an ADU specialist that I deal with all my deals with ADUs, right? You know, we talking about it, Dr. Sharon Barnes. Actually, she was out there with me when I was looking at these ADUs. And she's a wealth of knowledge. When I say wealth of knowledge, she has a doctorate degree in law. Okay? And so every time I have a question, yes, Dr. Barnes. How you doing, Dr. Barnes? I need to talk to you, Dr. Barnes. She gives me everything I need. And so with that being said, she'll walk you through the process of how to build it, what you need to do. Because sometimes you can buy a house and you think that you can put an ADU out there and you can't because of the backyard's not ready yet. You have to have certain criteria. She can look at a home. She has a software that looks on a home and say, okay, yes, this can do it. But then you got to get something called an inspection, an engineer report to make sure that the backyard can sustain it. What if the backyard, it has sink units in there? You can't, when you put a house on top of it, next you know your house is in the ground. That's why we say sometimes you can't just eyeball it. You got to get a professional to know if you can do it, because you want to buy the house and you bought the house specifically to do that, and you can't do it, you're gonna be pissed, right? That's how it works. Okay. The loans for those type of loans, we can do HELOCs, pull out equity from the mortgage to build it, or you can do renovation loans. So let's just say renovation loan. Let's say you don't have enough equity in your property right now. We can loan money on the after built value of the property. So let's say your house is worth $500,000 right now, but you're about to build this ADU, and the 80 you're going to add another 2 to 250 on the price of that, but it's going to cost you 150 to build. I can lend you money on the after build value. You get that appraisal price, say this is what's going to be worth, then that's what we're going to lend on. That makes sense?
Right, because now your property's not worth 500 anymore, it's worth 750.
750 or 800,000. Easy. Okay? And that's what we're telling the programs we have. That's why, so when you talk to me, my brain is just thinking. They say, okay, this may work, this may work. I'm gonna give you 2 options. I'm not gonna overwhelm you, but these are the best 2 options. You pick, you let me know. Doesn't matter to me which way you go. But I'll only tell you, if you say which one I think, I'll tell you the reasons why I would go with this one first or this one second. Okay? So, ADUs, SB9 units, SB9 units, I love those. And then we're talking about building. So you say, I want to go get a piece of land I want to build because I've always wanted to do that. I want to be like Outlander. My wife likes Outlander. She wants to build her cottage and things like that, right? We have what we call one-time closed loans, which means I can loan you money to buy the land and construct your home.
Oh, yeah.
Oh yeah, you didn't know that? Oh my goodness, yes, we got those too. So it's like a renovation loan, but it's from when you first buy it from the ground up. The rate is just slightly higher than the average rate, but it's not anything outlandish. It's a little bit more because it's like a construction loan and a regular mortgage rolled into one. Get the money as soon as you get it. You buy the land, and you start building. And so what happens is, as the contractor builds, every time he finishes a phase, we have the inspector. It's like inspector. I forgot the actual name of it. It comes out and says, yes, this meets everything, and he signs off on it, and then the lender sends him a check to start on the next phase. Come back in, check. Come back in, oh no, that's not right. Okay, gotta fix it. And that protects you in this process as well. Once it's done, boom, bam, boom, you move into a new home that you bought with one loan instead of traditionally going to get a construction loan. And then in the construction loan, you have 3 to 7 months to get out of it.
All right.
You don't need that. Now you have one loan to do that. Now I will say this because I've got a little bit of time left. The difference between an FHA and a conventional loan. All right. If you go FHA, when you get an appraisal for the FHA, they're more stringent. So let's just say on an FHA loan, on the outside of the house, the paint is chipping.
Fix it.
Gotta have that fixed. Right? Conventional, chip paint, it's not structural, we good.
Right.
For the most part. FHA, if I come in with something like, oh man,
Smoke detectors.
well, you have to have smoke detectors, no matter if it's FHA or conventional. You gotta have smoke detectors, and your water heaters have to be double strapped. They started that back in I think it's 08. But you have to have it double strapped. But it's just easier with the conventional. I mean, when I say easier, I'm not saying that it's hard to get an FHA. It's just if the property is a little bit warm, they're gonna look at it more closely. Okay.
Right.
Conventional, they're looking at it. If there's no structural damage, we're good.
Right.
Okay. On the FHA again, more. Yes, ma'am.
I didn't hear you say a 580 FICO score with FHA loan without the down payment assistance.
580 FICO score. I can go down to about 550 FICO score. So let's just say, for sake of argument, you have one of those not so good credit scores. Not bad, it's not so good. You go down to 550. 550, normally FHA loans, you can get it for 3.5% down, right? No, 3.5%. If it's under 600, you typically got to put down 10%. Most lenders not going to go past 580. I can go down to 550, but you got to put 10% down plus closing costs. And so I had a young lady a week ago. We were talking. We got everything. I got approved, but we couldn't do 3.5%. She was like at 551. I said, I got you though. I said, you may not like what I'm gonna tell you, but I got you. I can still do it. 10% down. Got to pay your closing costs, and she had to pay off I think it was $1,500 worth of collections because that they change. Got to do it.
Okay.
So it came out to roughly about $45,000 for the house. And it was everything to pay off what you need to pay off, to get everything in, down payment, closing costs was about $45,000, which is still for what she was trying to buy. It was hell, man. If I could all day, every day, we'd do it. She just didn't say she didn't have it. I'm like, okay. Think about saying you can get somebody to loan it to you, whatever you gotta do, or you just gotta just wait and then build up, and when the time is right, we'll do it again. By that time, maybe your FICO's up higher. If I get you over 600, which I try to tell you, you can do this to get over 600. Once you're over 600, now you don't have to worry about that 10% and back to 3.5. So from 5, you got to come up 50%, but you may have to pay off some stuff and do some things like that. It may take a little bit of time, but you can do it.
Okay. And you just said maybe get somebody to lend you some money.
Yeah.
How would that work?
Well, I want to say lend. It has to be a gift. It's a gift. It's a gift.
It's a gift. Okay.
It's a gift. So let me take that back. It's not lent, because technically it has to be a gift. It has to be, because we're gonna give a gift letter.
Yeah.
You're gonna sign it. Your donor's gonna sign it, and on that letter it says this is not loan.
Right. So,
And then do they have to show their statement too?
If you do an FHA loan, you have to show the statement to make sure the money's in
From the
there.
lender. Okay.
In there. If we do a conventional, I don't need a statement from them. All I need is them on that gift letter, it's going to be wired to escrow at close. They do got to put their account number. They got to put the name of the bank and the account number. But when they send it to escrow, all we're going to do is check to make sure it came, that their name's on that account and that account number is the same. But I don't need a statement. Unless they give it to you directly before we close, and I got to see the statement to make sure it came from that account. Okay? Great question, great question. Again, come on, sugar, let's go.
We have 12% battery on this.
12% battery of this?
It's
I appreciate it. Okay, I got another battery somewhere. You know what? Let's do this. I'm gonna close this off real quick, and then we're gonna go ahead and answer more questions.
Yeah.
First of all, everybody, I want to say thank you for tuning in. I want to say thank you for giving me the opportunity to educate you on the mortgage process. I really enjoy what I do. If you have any questions, give me a call. 888-488-5066. You can also go to YouTube and look at TRtheLoanGuy. Again, YouTube.com/@TRtheLoanGuy for multiple videos on down payment assistance. And if you have any questions, go from there. If you want to apply, go to SceptreMortgage.com/apply or TRtheLoanGuy.com/apply. And once you apply, I'll get that notification, and either myself or one of my loan officers will give you a call, and we will walk you through this process. Okay? Remember, keep your mind right and keep your hustle tight. TRtheLoanGuy, signing out.
All right, thank you all for coming. My name is Jaden, aka the Numbers Guru. If you listened and you take action upon what information was provided for you today, then you will be that much closer to realizing your dreams of being a homeowner. If you have any questions, call my dad. Thank you all and good night.
Well done, young man.